My guest this morning is Cody. He spent 17 years as a New York City police officer, and now he's no longer chasing bad guys down the streets of New York City. Instead, he's finding ways to legally reduce tax liabilities and help clients keep more in their pockets. He's also the co-author of the Amazon bestseller, Secrets of a Tax-Free Life. Craig, welcome to CREPN Radio.
Thank you very much for having me. Psyched to be here.
Yeah, I'm glad to have you and looking forward to talking to you. Before we get into our talk, though, if you could do myself and the listeners a favor and tell a little bit more about yourself.
Sure. I retired about 17 years ago, almost 18 years ago from the police department. Somewhere along the way, I got very interested in taxes. I went back to school for my accounting degree. I graduated. When I left the police department, I went to work for an international accounting firm, kind of honed my skills there. I've always been into planning, starting with estate planning. They kind of changed the rules maybe about 10, 12 years ago, and kind of just continued doing accounting stuff. And then after getting crushed in the downturn in around '07, we had to remake the practice. And probably around 2010, 2011, we looked at some of the estate plans that we did, and we realized that, we're also saving these people a lot of money in income taxes. So we made our way into the, tax planning arena and have been doing that for about 6.5 years now. So we work with small business owners and real estate investors predominantly.
Gotcha. Now, the saving money on taxes, it's certainly a topic fresh in the news, and it seems to be omnipresent. There's always a topic there, and we're nearing tax season when everybody is much more conscious of it, when you have to go see your tax professional and pay, right?
Yes, so there's about 7 weeks left in what we call tax planning season. So now's the time to, talk with your CPA and figure out how to keep more of what you make.
Yeah, no, absolutely. I know from personal experience, if you don't do it now, it'll be too late and be doing it for next year, kind of thing. So.
Right. Yeah, unfortunately, most investors are not communicating with their CPA. And CPAs aren't communicating with them. So everybody is kind of being reactive. They're sitting down in, March and April instead of, throughout the year. So they're, putting the right numbers in the right boxes, but they're not being proactive and looking for ways to, really save the client tax money.
Right. Well, let's talk a little bit about real estate investors and what are some problems you see that they're not doing? And let me back up here 1 second, because I'd rather start by saying a non-real estate investor versus a real estate investor. If we could make the case for the benefits of real estate from a tax perspective, is that something we can talk a little bit about?
Oh, depreciation. Yeah,
okay.
I mean, depreciation is really the big thing. It's like that non-cash expense where you get to write off that property, depending on whether it's residential real estate or commercial real estate, somewhere between 27 and 39 years. So that's a big thing. So it's kind of like tax-free cash or a non-cash expense.
Right. No, I think that the somebody who's not in real estate and they're constantly. I mean, I get friends and colleagues I hear talking all about it, and they don't have a vehicle to capture any kind of depreciation and lower their tax bill. So it's a huge concept, and I for people that aren't yet in real estate or don't own a business and don't have some sort of capital equipment where they can actually depreciate something, they don't really fully understand it, because it doesn't. You understand it from a standpoint of you buy something and you can't sell it for, like a car. Typically, you can't sell it for what you bought it for. But with real estate as an appreciating asset, the concept of depreciation, unless you're in it and you understand it and you have a tax professional that's helped you understand it, it's not a concept that you've experienced. You may have heard the word, but to see the numbers work.
Yeah, exactly. Until you actually see the numbers work, because we'll get, yeah, I'm making money, and I'm like, well, maybe you're cash flow positive. You may not be making money, which isn't a bad thing. Okay. When we add in depreciation, it could turn what you think is a positive number into a negative number, but that's for tax purposes. That's not for what's going into your pocket. And when it comes to depreciation, we see a lot of mistakes on depreciation, and not really sure why. We just think people are not taking the time to review the items that are on that tax return. But another often missed thing we see is cost segregation. And I'll just kind of go into what cost segregation is. Typically, let's take a piece of residential property is depreciated over 27 and a half years. So they buy that property, they separate out the land, and they depreciate what's left by 27 and a half years. When they do a cost segregation study, they break that building out into 5-year, 10-year, 15-year property. So over the 27 and a half years, you get the same amount of depreciation, but you get more up front. All right. And when we go to commercial property, it could be even bigger because now you're spreading things over 39 years. So when you're moving things to 5 years and 10 years and 15 years, you're getting a lot more depreciation expense up front. And a dollar today is worth a lot more than a dollar in 39 years.
Sure. And also just in I think from practice, when you, when you're buying a property, maybe you're going to be, maybe it's a value add opportunity where you're going to have to invest some money in the property, or you've got some management issues to change. And so that first year may be kind of a lean year from a standpoint of implementing these changes and some costs, but to be able to take advantage of that depreciation and accelerate that and offset your income and really increase your bottom line there, that's huge. And it's something you don't really,
yes,
you don't necessarily see on just the operating, cash in and expenses out. It's at the end when you see that, to be able to accelerate that depreciation. That's huge.
And that's why everybody's doing it.
Yeah. No, that's good.
That's the big secret.
Yeah, exactly. So all right. So the we talked a little bit about the benefits of real estate. What are some things? And I mean, we've talked about depreciation, and we've talked about cost segregation. What are some things that you see or that you would like for a real estate investor that they're doing this? Maybe they're not, like you've mentioned, they're already not taking advantage of these things, but are there some keys that they should be looking for, or just some cues throughout the year? I mean, we talked about estate planning or tax planning. It's not just a once a year event. It's like you said, it's an ongoing conversation. You need to be aware of it throughout the year. Are there some things that you can point to that would be useful for our listeners that are real estate investors to help them throughout the year?
Yes. Well, they should definitely communicate with their CPA. But aside from that, there are some strategies that they could use that'll help lower their income. But before we go into that, a lot of people, they don't realize that with real estate, if they have a W-2 job and they have 1 or 2 pieces of real estate and they're not considered a real estate professional, that they may not get the benefit of those losses. So, we'll get calls a lot of times where, I'm making a couple $100,000 a year and I bought this real estate because I wanted this deduction, and we have to break the bad news to them that, real estate is by nature passive. And you could be an active real estate or a real estate pro, but you have to jump through some hoops and stuff like that.
Let me ask you, so when that is the case, that depreciation's not lost, it's just you can't use it at that moment in time, right? I mean, you get to carry that forward, is that right? Or
exactly. It kind of sits on your personal balance sheet of your tax return as passive losses that accumulate, and until you have passive income or you sell that property, okay? So when you sell the property, all the passive losses associated with that property are released, and you get them in the year you sell it. Or when you have other income that's passive that comes through, then it gets offset by those activities. So that's where, if you're a business owner and you have real estate, there are some unique planning opportunities. If you have these passive losses coming in from your real estate, are there legal ways to create passive income?
Gotcha. So what do you? I mean, you mentioned you before the call, before we started recording you work with small real estate investors and business owners and larger real estate investors. Is there a line? I mean, you mentioned passive versus somebody that's actually a real estate professional. Is there a line of investor where you see that is needing more help, or a common issue that you see that you could speak to?
Yeah, well, typically, if you have more than 5 rental properties, you might need a little bit more help than somebody that's just getting started in the field. But they can all take advantage of certain things, such as, the home office deduction, all right, if you do it correctly. What we call a medical expense reimbursement plan, all right, which basically allows you to write off all your out-of-pocket medical costs. So you might have insurance, you might have a high deductible plan, but your insurance may not pay for your kids' braces or eyeglasses or contact lens. And those are things that you're able to write off through a medical expense reimbursement plan. And if you do the planning correctly, now you get those deductions. And obviously it helps if you're making money on the real estate, so you get the benefit of those deductions rather than them sitting there for later on. But at least they're sitting there for later on.
Right.
So there are a lot of things that small investor can do. And it's really just amounts to being proactive and communicating with their CPA.
Gotcha. So in your conversations with real estate investors, is there a kind of a strategy talk that you get somebody new that you're trying to help out, or that they're asking questions, or how to get them set up so that they're going forward? Is there a kind of a do this is an LLC, or entity talk, or can you?
So, sure, yeah. Well, because we've come across a decent amount of individuals that they're in that smaller stage, and they want to get to the bigger stage, but everyone has to start somewhere. So we've developed what we call our small real estate investor plan, which is geared towards those new investors and gives them the things they need to get some benefit and some tax benefits out of the plan. It's not a full-blown plan that we would normally do for somebody with, maybe a business and some real estate, but they still get, a lot of benefit, and it sets them up so they could actually make sure they're doing everything they should be doing, all right, versus waiting for 5 years, doing it all wrong, and having a problem.
Gotcha. Is there any kind of a territorial limitation on where somebody can, take advantage of that, or? I mean, is it?
No, I mean, we have clients. No, we have clients all over the country. I mean, as far as we're in New York, we have as far as Oregon and Washington, the Dakotas, pretty much all over. The internet's a wonderful thing, just like we're doing right now. So there are no boundaries. Yeah, obviously you need to know what's going on in those states, but I have a network that we could go to for that kind of stuff. And it just comes down to you need to plan. You need to communicate with your CPA, because the doctor doesn't call you up and say, "How are you feeling today?"
Right.
So you need to communicate with him, and if he doesn't communicate with you, then you need to go and look and find somebody else that's going to communicate with you. But most accountants want to do the right thing.
Gotcha. I'm trying to think. Is there a one thing that you would recommend our listeners do to help save on their taxes from a real estate standpoint?
Well, I think I'll give you 2 things. I think they should look at liability protection, because we come across a lot that don't have the liability protection, and we've seen some horror stories. So maybe an LLC, depending on where you're located, it might be a good idea to just put that property in there. And then just like simple things like the home office. Are you doing that? The home office opens up the ability to have an on-premises athletic facility, which could be your gym or your pool. You get to write that off. Or auto expenses, the right. If you have to do everything right and dot your I's and cross your T's, but there's a lot of opportunities for the small real estate investor. And then we get, as far into depreciation and cost segregation, it could make a lot of sense.
Right. No, all of those things. And again, I think the aha moment for myself was when actually, after having owned a property and feeling like I was losing my rear every time, every time I got a bill or the little bit that was left over for me, kind of thing. But when I went to see my tax professional, and that recognition of the expenses were expenses that went against the income, and then also the depreciation. When I was first starting out too, I mean, the income, my overall income was lower, so it was like I was excited for tax season to go see my tax person. It's
Yes.
changed a little bit since then, but
It changes, and I mean that's the beauty of real estate, though. Over time, historically, the rents have gone up.
Right. No, and that thereby the appreciating asset with this depreciation, the ability. I think that to me is one of those. Again, when you talk to people that don't own a business or don't own real estate, it's hard for them to understand that the benefit of that depreciation, because usually depreciation is a bad thing from a standpoint of you. Like I said, most people are familiar with they bought a car, it depreciates, you can't get what you paid for it, kind of thing, and that's the end of it. And to actually have a positive experience with that, and see the benefit, that's huge.
Right, and one of the ways on a sale to deal with that depreciation, because when you sell the property, you actually have to recapture that depreciation, pay income on all that depreciation. So, 1031 exchanges are another way to take advantage of, not having to pay tax on that, that depreciation and deferring it down the road.
Hey, let me ask you a question. This is something that I was talking with somebody else about, and I know just talking about the depreciation and 1031 and the capital gains, et cetera. Let's say you've had a property for a number of years and you want to sell it, and the buyer offers you the owner financing. From a standpoint of how that's treated tax wise, if you bought it for 10 and now you're selling it for 100, there's a gain of 90. You've got your depreciation, you've got a recapture, right? Because you obviously sold it for more than you're selling it for more than you bought it for. Can you talk briefly as to the tax treatment or the benefits from a seller's perspective to providing seller financing from
Right.
does that make sense?
Yes. So, I'd have a big smile if I made $90,000 on that property, but then I'd think about the tax bill. So, when you use seller financing, it's basically treated as an installment sale. So you pay tax, they figure out the percentage of each payment that is actually the gain and how much is your initial principal. And as you get paid, you pick up that much every year in income and pay tax on it.
Right.
So that's the short version.
Well, and if you've ever looked at the amortization schedule, those first couple of years are full of interest, right?
Yes.
So the interest is treated what is ordinary income then, or is that
interest is interest?
Interest,
exactly.
Okay, or
interest
income. Okay, and so then that basically answers that. You've got the gain percentage that's treated per installment on an annualized basis is what you'd be facing the tax liability for that year, correct? As opposed to one lump sum kind of thing. Got it. Craig, is there? I know we talked about your small investor option there, and I want you to be sure to let the listeners know how to get a hold of that. Is there something that you could, or an example of a recent client that you could, give a little. Somebody they had done this, and then we met with them and were able to save them this, or
Yeah, I mean, I'll think of a recent client that we're working with has a lot of decent amount of real estate, and we're in the process of doing a couple of cost segregation studies. So he's going to pick up, on one property, he's going to pick up like $50,000 worth of extra depreciation in 2017. And the wonderful thing about that is with cost segregation, if you've had the property for a number of years, you do the study now, you pick up all that missed depreciation from the last 7 years. So it's a good planning technique if you happen to have a good year, maybe you sold a property or something like that, and you want to be able to offset that. So, there's a lot of different things that we're able to help the real estate investor do. But like this was a recent client, and so he had a bunch of real estate. We set him up with a medical expense reimbursement plan. His two kids happened to get braces. That was $14,000 that he was able to write off. That he really wouldn't get the benefit of the write-off if he had done that on Schedule A. And then he had these cost segregation plans that we were doing. So that was just the cream of the crop on the top. So
Got it. And one of the other things just occurred to me, and I know so often we talk about in real estate how it's kind of a team sport. It's not kind of, it is a team sport. I mean, you have to have, broker, lender, CPA, insurance. I guess what I'm trying to think of is from a standpoint of when somebody has identified a property and they're excited about an opportunity. At what point would it be wise? And I know we've been talking about this thread of this conversation is to make sure you're talking with your accountant, right?
yes,
But I think where I'm going with this is, at what point would you be would you suggest somebody gets in touch with you and says, hey, this is what I'm looking at? I mean, it should be like before they make the offer so that they know they get somebody to look at it and make sure it is what they think it is, or is there a more of a tax strategy, or is there any kind of advice you can give there?
yeah. Well, depending on the price of that property, if it's a lower price property, they can make the offer and have that conversation with their CPA afterwards before closing. And the same thing goes with a sale. Maybe there's a better way to do it. And so many times they'll come to us after, well, I sold this, I made all this money, and I'm buying this other property. I'm like, well, wait, if you would have come to us, and we could have did a 1031 and you would have saved all this tax because you're really just going into another property. So I think you should have a relationship where you communicate with your accountant, CPA on a regular basis so they know what's going on, so they could, you don't know what you don't know and they don't know what they don't know. So if you communicate, they're more in the loop, right? And it doesn't mean you have to call them every day, but, you should have a working relationship where you should feel comfortable reaching out and, maybe not be worried about getting a bill, okay, but having a relationship where there's a value add there.
Right. No, I think that's definitely something I've come to recognize the value of that, and like I said, the fact that real estate is it is a team sport, and if you're trying to do it all yourself, and just that comment you made about somebody who sells the property and they're all excited, they come see you, and they've got this. They're all happy when they come to see you, and when they leave your office, they're not happy at all. And that could have been avoided, had there been some sort of a conversation and planning, on your part to help them, retain that. Well, that's great. Craig, I'm kind of running down my list of, questions I can think of for from tax and real estate. Is there something that you'd like to, share or comment on before we wrap this up?
Two things. I wanted to offer you listeners a copy of my book, my most recent book, which is the 10 most expensive tax mistakes that cost business owners thousands, and it pertains to real estate investors also. So we'll give you a link to your show notes, which would be www.craigcodyandcompany.com/CREPN for Commercial Real Estate Professional Network. And there'll be a link, and they could request a copy. We'll mail it out. And I think it's just really important to make sure that you're communicating with your CPA, and use them just like you use your attorney. You know, you wouldn't buy a building without speaking with your attorney, right? You wouldn't sign a contract without speaking with the attorney. Use your professionals, all of them. The insurance guy, okay, your realtor, whomever it is. Use these people. They're part of your team. Like any business, you should have a team.
Right. No, that's good. That's good. All right. Craig, what is the best way for our listeners to find out more about you or get in touch?
Well, there's our website, which was CraigCodyandCompany.com. They could reach us at 516-869-4051, or email is craig@ccodycpa.com. There's a lot of C's in there. I'm sure you'll have that all on your website in the show notes. Just reach out to us, and we'll help point you in the right direction.
Got it. No, and for listeners, we will have all that listed in the show notes. You can find all that there. Craig, I want to say thanks for taking the time to talk. I've enjoyed it.
Thank you very much for having me. I appreciate it.
All right. Hopefully we'll do it again soon.
Yes. Have a great day.
All right. And for our listeners, if you like the show, share the show with someone you know. It's really, really easy to do. You can share our interview with Craig and help others grow their real estate portfolio. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.